The investments that one makes in this period will probably be the best for many, many years to come because they'll have the most asymmetric upside, the end of this phase of big tech. So I'm constructive. I'm a little bullish. I'll go out on a limb. I think, we could be 3 to 5% from the lows, but we're more near the lows than the highs. This is why I think we're in a bottoming process. Ours will play out over 6 or 9 months, but it's going to play out the exact same way. Mark my words. The Federal Reserve will intervene.
Billionaire venture capitalist, early senior executive at Facebook, and investor in Bitcoin since 2012, Chamath Palihapitiya has a proven track record of seeing tech trends early and knowing when to get into the next big thing. After correctly predicting the top of the market in Q4 2021, he now says he believes the market is nearing its bottom. In this essential investing highlight, Chamath puts forward his argument that the savvy investor should be paying attention to right now to capitalize on the next big wave of technology companies that will change our world and make their shareholders millionaires. While he doesn't think the bottom is in just yet, he does suggest we are nearer the bottom than the top, and he reveals that he is starting to place some of his bets for the next leg up.
Well, it definitely is the end of an era. I think it is sort of like the end of this phase of big tech where you had this unfettered growth, where these business models were largely unassailable and they, were really just fighting to grow into their valuation and just generate more revenue to justify where they traded at. And now it's this next phase where they have to operate more like a cash cow business. And so, it's an acknowledgement that the growth is tapering. It's an acknowledgement that they're going to trade on a pretty tight band in terms of multiple. These companies, Apple, Facebook, Google, maybe a little bit Microsoft, are the most sensitive to valuation because they are the most widely held, right? These are the equivalent of US Treasuries in the equity markets, the safest, most predictable safe haven in times of stress. If you want to own big, chunky cash flow generating businesses that, are relatively unassailable, you couldn't pick 4 better businesses than those. And so the fact that they see enough in the horizon to say that we need to batten down the hatches should be a warning to everybody else. It's another data point that, again, I said it last week, I'll go out on a limb and predict my equivalent November fall predictions. Last fall, it was that the markets were going to poop the bed. My prediction now is that I think the markets are bottoming and consolidating. This is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. And from my perspective, I'm actually starting to get a little constructive here. I think that when companies like Facebook really do this, and if you think about it one way, the financial markets have always had this thing that we have called a Fed put. What does that mean? A put is essentially the right to sell something. And what market participants have always known for the last decade is that if things got very hairy, if there was uncertainty in the market, the Federal Reserve would, and they have, consistently stepped in to create a buyer of last resort. And so it always eliminated that last part of true, supply-demand balance, because they would just come and say, don't worry. In many ways in tech, what the big tech companies were that. You could never really find what the true market clearing price for an engineer was, or what the true amount of expenses you should spend on office space or, free services. Because you always had these companies, which was an escalating arms race. If one company had a massage, the next company had gyms and massage and physical therapists, and the other company would have buses to take you to the gyms and massage and therapists, and the next company would have protein shakes that were freshly made. And it just kept escalating and escalating because the costs didn't matter. And they wanted, if nothing else, to get that marginal engineer or product manager or business person to work at their company, which eliminated the risk that they would actually start something to disrupt them. So when you take this big tech put out of the market, you will get true price discovery, and you will find out what the real price should be for this kind of an engineer, that kind of a product manager. You'll find out what are the real expenses you need to bear in order to build a real lasting business. and you'll be able to sort through all of that stuff out. So I think it's a really good moment. And again, it's yet another indication to me that I think broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down, the alcohol's being taken away, people are hanging around with a little bit, lights are coming on, they're like, oh, I've been here a little too long. And I think that that's a very healthy process for an economy. And I think that that's what's happening right now. So I'm constructive. I'm a little bullish. I'll go out on a limb. I think, we could be 3 to 5% from the lows, but we're more near the lows than the highs. The investments that one makes in this period will probably be the best for many, many years to come because they'll have the most asymmetric upside. And that was true in 2008 and 9 and 10. It was true in, 2002, 3 and 4. You're talking incredible companies just in those two periods. Think about this. Atlassian, Tesla,
Uber, Google,
Airbnb, Uber, Instagram, WhatsApp, incredible businesses that have created tremendous value. And so there are businesses that have been invested in for the first time in 2022 and will be invested in for the first time in 2023 and 24, which will be the leading winners of this next phase and this next leg up. And so the real opportunity is to find out who those companies are and get behind them.
So pretty rosy outlook from Palihapitiya, believing that most of the pain is behind us. This is in stark contrast to the billion-dollar investor we heard from in yesterday's video, Ken McElroy, who said we have much more downside to go. Let us know in the comments below who you think will be proved correct. If not, be sure to watch it next to guarantee you don't get confirmation bias by only watching the views you believe in. This is how investors lose their shirts in the markets. And if today's Essential Investing episode helped keep you informed, share the love by smashing that like button, because everyone knows that means 7 years good luck investing. And subscribe and hit the bell so you get immediate notification of tomorrow's video, where inventor of the dollar milkshake theory, Brent Johnson, gives us an update on the strong dollar and what he expects next. Brent has looked like a genius this last year by predicting the rising dollar and explaining the significance of it in your portfolio. In tomorrow's update, he tells us where the all-important DXY is headed next. In the final segment, Chamath shares his observations of the recent debacle in London, where the Bank of England completely reversed course after the British pound collapsed nearly 10% in mere weeks. He then uses that as a guide to predict what and when something similar may happen in the US.
Mark my words, the Federal Reserve will intervene. This is why I think we're in a bottoming process. I think the bleeding edge of the smart financial actors are actually on Sachs's side and Friedberg's side. But then they're taking that next intellectual leap and saying, okay, well, what happens when Apple basically says, hey guys, I'm going to have to fire 15% of my employees? I think what happens is the Fed intervenes. And I'm just using Apple as an example. But there is a threshold of demand destruction, Jason. I think you're right, where we have the Fed put come back on the table and the markets just go bonkers. No. They're gonna get to 4.5 very quickly. And then something's gonna break, like all these guys are saying. I think they're right. And then the Fed put comes back on the table. The UK thing happened in 6 days? Ours will play out over 6 or 9 months, but it's going to play out the exact same way.
Thanks for watching today's Essential Investing. I highly recommend checking out this video where famed investor Ken McElroy, with over $1 billion worth of real estate under management, reveals the grim truth about the collapsing real estate market, his interest rate predictions, and what you need to do to protect yourself and profit from it.